Well, ladies and gentlemen, property taxes are only one part of the global compliance puzzle. Because for thousands of Indians, the next financial risk is not hidden inside real estate. It is hidden inside foreign bank account. You know the biggest challenge? It is not reporting your Indian property to IRS. There is another rule that quietly catches thousands of Indians every single year. And this one has nothing to do with hiding income. It has everything to do with how the IRS calculates your property value over time. Many Indian families buy a flat in Bengaluru, Mumbai, Hyderabad, or any other Indian city with an idea of earning rental income while they work in the US. Every month, the rent comes in, the tenant pays on time, and everything seems perfectly normal. But behind the scene, the IRS is applying a completely different set of accounting rules that most people never ever think about. Well, the moment your Indian property starts generating the rental income, the IRS treats it as a depreciable foreign asset. You want simple words? Well, the government assumes that the building loses the value every single year, and that depreciation, it becomes part of your tax calculation. You know, the surprising part is that this adjustment, it happens whether you actually claim depreciation or not. Under the IRS's allowed or allowable rule, they calculate your property's adjusted value as if you had already taken those deductions. Now, fast forward 10 to 15 years. You decide to sell the property. You look at your original purchase price, compare it with the selling price, and you believe that there is a reasonable profit. But you know what? The IRS does not use the original purchase price anymore. It first reduces the property's value because of years of assumed depreciation. That means your taxable gain, that suddenly becomes much larger than what you expected. Well, for many Indians, this comes as a complete shock. They believe that they had already paid the taxes in India, claim the applicable deduction there, and complete the transaction. But the US tax follow its own calculation. Even exchange rate becomes part of the equation. Well, the purchase price is converted using the exchange rate on the day you bought the property, while the sale proceeds are converted using the rate on the day you sold it. The weaker Indian rupee can increase your taxable gain even further when everything is calculated in the US dollar. And you know, that is why selling foreign property is no longer just about finding a buyer. It has become a cross-border tax exercise involving depreciation rule, historical exchange rate, foreign tax credit, and detailed reporting requirement too. One small mistake can change your tax bill by thousands of dollars. The smartest approach is not waiting until after the sale. It is understanding these rules before you sign the final document.